Sam Bankman Fried is one of the richest people on the planet. By 29, he'd made $22.5 billion. He's most commonly known for being founder and CEO of FTX, a cryptocurrency derivatives exchange. But recently, Sam's reputation has been torn apart. So, in hindsight, has Sam Bankman Fried's actions been malicious from the start? We do all know that he didn't come into Bitcoin for the blockchain technology. This story is the rise and fall of Sam Bankman Fried and FTX. Fried's story begins in 2013, where he was a quantitative trader for Jane Street Capital, a New York-based proprietary firm. Jane Street is a market maker. They place both a buy order and a sell order on the same asset. The margin between the buy and the sell order is very, very small, so they make a very small profit. But when they do this on huge scale, these small profits add up. This practice adds liquidity to the stock market, and in the process earns Jane Street Capital billions of dollars. But Jane Street Capital isn't just a market maker for US stocks, they trade internationally as well. Trading these assets can create huge gains, but there are some additional complications. For example, exchange rate fluctuations, time zone differences, or regulations in specific jurisdictions. This is complex trading, but set Sam up great for his next venture. In 2017, Sam left Jane Street Capital with as many as 12 ideas on how to accelerate his wealth. He said in an interview,
"I'm not sure what I was actually going to do next. What I'd really done was sort of written down like 12 things I could do with my life, and felt like a lot of them were compelling, and I didn't know what was going to be best, but that, the only way to try would be to leave and just dive into some of them."
And one of those 12 ideas was to arbitrage trade Bitcoin. Back in 2017, Bitcoin wasn't a well-known asset, but its trading volumes were increasing massively. In fact, Sam Bankman Fried didn't actually know much about Bitcoin at all, but he did spot an arbitrage opportunity between the US and the Korean markets. There was a huge amount of demand for Bitcoin in Korea, and this created a 50% discrepancy in the price. If Bitcoin's price was $10,000 in the US, it was trading at $15,000 in Korea. Simply buying Bitcoin in the US, sending it to Korea and selling it could create a 50% profit. This was known as the kimchi premium, but because the Korean won is a regulated currency, it made it very difficult to upscale this, and you couldn't easily offload the Korean won. However, Sam looked for a different approach. He spotted another, less favourable arbitrage opportunity for trading Bitcoin. Sam had found a 15% discrepancy between the US Bitcoin markets and the Japanese Bitcoin markets, meaning if Bitcoin was trading at $10,000 in the US, it was trading at around $11,500 in Japan. So it was a smaller difference between the two, but it was an operation that could be upscaled. So he co-founded the company Alameda. This was a much easier process to upscale than the kimchi premium. However, it did still have its challenges.
Buy Bitcoin, send it to Japan, sell it for yen, turn that to dollars, send it back, and repeat. And then you just start hitting all these roadblocks. Like, this was late 2017, so like you create a Coinbase account, and like how long does it take for you to get KYC'd?
Weeks.
It's like 3 months.
Yeah, or a month. Yeah.
What are your withdrawal limits on Coinbase? It's like,
it was minuscule
5,000.
until you had to get like KYC AML, which took weeks in and of itself. Like,
exactly, right? So you send the dollars and like, shit, okay, gotta get AML. Then you sent it from like whatever, your JP Morgan Chase account or something, and that gets shut down. So like, you send money to Coinbase, you're like, yeah, they're like, cool, your account's closed. You're like, why? They're like, I don't know, we don't really want to do with crypto. I don't know. And so now you gotta get a new bank account, but of course at this point you're starting to worry that what's gonna happen with that one? Is that one getting closed? The answer is yeah, probably. So, okay, so you're playing whack-a-mole with these US bank accounts, and you're trying to get increased withdrawal limits somehow on some US exchange. You finally get that, so you wire in your dollars, you buy some Bitcoin, you send it out to your Japanese exchange account, then you realize you can't withdraw yen unless you're Japanese. So you gotta be Japanese, and you have to get your withdrawal limits raised there. And then finally you get to the point where you can withdraw, you sell it for yen, you can withdraw the yen, then you realize they'll only send it to a Japanese bank account. So now, I don't know, you're like looking for a Japanese bank account, but also you're not, well, you gotta be Japanese again to get that. All right, so you're Japanese again, you get your Japanese bank account, you like send the yen there, and you're like, can we send this to the US? They're like, no. Like, why not? They're like, no, you don't have an international bank account. Okay, so now you gotta go back and get like an internationally capable Japanese bank account. And then you're like, all right, can we send this to the US? So like, what are we doing with it? And you're like, it's crypto trading. They're like, can you repeat that? They're like, yes, it's a remittance. And they're like, how much are you remitting? Will this be like more or less than $1,000? You're like, it's gonna be more than that. They're like, it's gonna be more or less than $10,000. You're like, yeah, it's gonna be more than that. They're like, I'm sorry, you cannot do more than that each day.
Alameda's end solution to this problem was complex, but it was important for them to act quickly in order to take advantage of this arbitrage opportunity before it was too late. So Alameda did get a Japanese bank account, and every single day, as many times as possible, they would wire USD to Coinbase, buy Bitcoin, transfer that Bitcoin to Japan, wait for block confirmation on that transfer, sell that Bitcoin on the Japanese exchange for yen, withdraw that yen to the Japanese bank account, convert the yen to US dollars, and then wire that back to the US. Also, they could start again tomorrow. But because of the time differences, they only actually had a 1 hour period that they could operate in. And remember, this was 2017. Online banking wasn't very user-friendly. The interfaces were difficult to use, and to convert the yen to USD, you could only convert $100,000 at a time. And Alameda actually managed to upscale to $10 million to $15 million a day. So when trying to transfer $100,000 worth in each transaction, it took a long time to do this. The team would work together to convert as much as possible until the last minute, where a colleague in Japan would go to the bank and wire that money back to the US so they could start the process again the next day.
We had different teams in both places. So we had a team of people who spent like 3 hours a day in a US bank. And we had a different team of people who spent like 3 hours a day in a Japanese bank.
Wait, and back up, Sam. Who's the we? Are these like Jane Street buddies? Are these college friends? Like,
this is post Jane Street. So this is when I started up Alameda. And this was like Alameda's first really big trade.
but who'd you
was trying
start
to spin
Alameda
this up.
with? Like, who are these people?
Random selection. I mean, it was like people I knew from high school, from college, from effective altruism, from, I don't know, like a friend of theirs. Like it sort of like just grew sort of out from like, people who knew people who were, we had like 50 interns coming in and out over the first few months. I mean, it's just like hordes of people. And we'd have like the team in the United States. So you get the money off the Japanese exchange, and then you had to use the website to turn it into dollars, but it would only do 100,000 US dollars at once. And it was like a minute-long prompt that you had to click through. It was like many screens that loaded very slowly. The problem is that there's about an hour between when the wire transfer hit Coinbase and when we needed to wire out from Japan. And in that hour, we needed to buy Bitcoin, send it to, Japanese exchange, Bitfly or whatever, wait for the blockchain, sell it, withdraw it to the Japanese account, wait for that transfer, turn it into dollars, and then go wire it out. And so we had like 5 minutes by the time this is over, when we're at this like converting step, and it took a minute per $100,000. So we just all stopped what we were doing. We all broke out, got on our computers, started just like, clicking through.
So everybody during
like,
this 1 hour, everyone during this 1 hour is basically doing it.
That's right. And eventually, like when we had like 1 minute left, we were like, all right, guys, it's time. Whatever it's at, no more. And then someone would call up, our team in Japan, be like, who had been basically like got in line, like got to the front, and then just like kept letting people pass them, but like keeping their spot in the queue for the bank teller. Then we call them like, all right, it's time, go. It's like this is a notional, and then he, walk up to the bank teller and say, all right, send the wire transfer now, and they're like, to where, and like said all the details, and I like watched as I typed in like the reference, those like fucking reference numbers you have, everyone's like 3Q7 T, and like no, it's a G, not a T. I'm like, T, no, you gotta cross that out. It's a G, not a T, and then eventually, like, hopefully, they submitted it before the cutoff, and if they didn't, you lost 24 hours.
As you can see, this was a complex, time-pressured operation, but Alameda managed to profit as much as 10% each working day. And they only had a couple of weeks to capitalize from this, hence the huge volumes, because eventually the price difference would be so small that it wasn't profitable. It was here in 2018 that Sam moved to making his own cryptocurrency exchange, FTX. This was a well-trusted platform that allowed people to buy and sell cryptocurrencies or derivative contracts. And the company really flourished out of Sam's frustrations at the platforms that were available at the time.
It was like late 2018, and I always wanted to start an exchange because they just seemed like really important products in the crypto ecosystem that were worth a lot, played a really big role, and were not necessarily even the hardest to build. Sort of that combined with just an extremely large amount of frustration with the current products. Some of this was almost a like, if you won't fucking fix your product, I will do it for you type thing. There's like 2 exchanges whose derivatives were together more than half of all crypto volume. And it was just a total mess. I mean, it's like $350 million of customer funds lost to like, improper liquidations that year. There was, impending lawsuits. There's matching engines that couldn't keep up.
It was recently reported that FTX handle 10% of the crypto derivatives that are traded. And in this business, Sam has again taken the route of taking a small percentage on huge volumes. FTX take on average about 0.02% of each trading fee. This on huge scale can make huge profits. Fast forwarding to 2021, investors valued FTX at $18 billion. And in January this year, the exchange and its US operations combined hit a $14 billion valuation. Things were going well for FTX and Alameda. Even during the bear market after UST pegged, FTX was acquiring other businesses within the cryptocurrency space. But in the last couple of weeks, this has all changed. Sam's reputation has been torn apart. So let's take a look at what's happened. Back in August, the Alameda CEO stepped down. And then in September, we saw the FTX president make the same move. Shortly after this, we had Texas security regulations were probing whether crypto-earn offerings are securities. And they said that FTX should not be able to buy Voyager assets. On the 2nd of November, Alameda's balance sheet was leaked. It was rumoured that as of the 30th of June, the company held $14.6 billion worth of assets, much of it being FTT, FTX's token. The $14.6 billion breaks down as follows: $3.66 billion being FTT, $2.16 billion being FTT collateral, $3.37 billion being crypto made up of Sol and Loxol and a few others, and then $134 million worth of US dollars and $2 billion worth of equity securities. I'm going to jump in now and talk about the timeline of events that have occurred since FTX's balance sheet was released. As many of you will be aware, FTX is now paused withdrawals. A lot has taken place since I started this video, but we want to finish it, then we will have the whole understanding of what the start of Sam Bankman-Fried's career looked like and what it looks like now, which I must say is not good at all. So let's carry on with this timeline of events. So as mentioned, the balance sheet was released and it had a lot of FTT tokens on it. FTT is a token issued by the FTX platform and allows holders to pay smaller transaction fees. So by holding their own tokens on their balance sheet, it is a problem. And it seems that their balance sheet is made up of illiquid altcoins. Following this news, CZ took a drastic measure and publicised it on Twitter. CZ is the CEO of Binance and he tweeted that he was selling his FTT tokens. And he actually compared FTT token to Luna, the token that plummeted early this year when UST depegged from the dollar. And this announcement from Binance caused the FTT price to plummet. But it seems CZ was right. A couple of days later, FTX paused withdrawals. Now this isn't the first time we've seen this bear market. We've seen so many platforms do this and it's so sad to see because a lot of people are losing access to their funds. And lots of people didn't expect this from FTX because Sam Bankman-Fried has been going out and offering to bail out different companies during this bear market in an attempt to monopolise the cryptocurrency industry. But on the 8th of November, FTX paused withdrawals and actually reached out to CZ and Binance to see if they wanted to acquire the platform. Now this was just ftx.com, this was not ftx.us. And Binance signed a non-binding letter of intent so they could research and do their due diligence and see if they wanted to acquire the company. But unfortunately, they decided against it. Their spokesperson said it was beyond their control or ability to help. FTT's token has plummeted 75% at this point. And then on the 9th of November, it was announced that the SEC was investigating FTX under the allegations that the company were mishandling user funds. So what these allegations are suggesting is that, like a traditional bank does fractional reserve banking, it seems that FTX was doing the same. Now this is not allowed. And following Binance not acquiring the company, they looked elsewhere. They looked for $9.4 billion in order to save the company. They were in talks to raise capital from OKX, a rival cryptocurrency exchange, and from Tether, the USDT issuer. But the only deal he managed to make was with Justin Sun. This is the founder of the blockchain network Tron. And the deal allows those that had Tron-related tokens on the FTX platform to withdraw those tokens. But things continued to get worse. Although on Twitter, Sam Bankman Fried was posting that FTX was unaffected, on the 10th of November, there was a banner on the ftx.us website saying that trading may be paused, so to close any positions that you don't want to leave open, but that withdrawals would continue. And then on the 11th of November, Sam Bankman-Fried's world officially fell apart, and FTX filed for Chapter 11 bankruptcy. And this bankruptcy includes FTX.us. Sam Bankman-Fried has now stepped down from CEO of FTX, while affiliated companies proceed with bankruptcy proceedings. And just to make this all 10 times worse, there was then a hack of FTX funds. $1 billion in funds in FTX have now gone missing. And this was on the 12th of November. After Sam Bankman-Fried moved $10 billion from FTX to Alameda Research, around $1 to $2 billion of that disappeared. And blockchain analytics firm Elliptic have said, assets were moved out of FTX wallets in suspicious circumstance early this morning. But the FTX US General Counsel said they were just moving funds to cold storage. And this brings us almost to date. Yesterday, on the 13th of November, authorities stepped in. And FTX is based in the Bahamas, and Sam Bankman-Fried has been questioned by Bahamian police. So that is where we are up to today. Unfortunately, this has been terrible for the cryptocurrency industry. We've seen the price of FTT plummet. We've seen the price of Solana plummet. We've seen so many users lose a lot of their funds. And this was one of the biggest cryptocurrency exchanges. So it's really had a detrimental effect on the cryptocurrency industry. And it does have a domino effect. We've seen this before. We've seen many people over the last couple of days begin moving their cryptocurrencies out of any centralized exchanges in order to keep their cryptocurrency safe. And it does remind us of the famous phrase, not your keys, not your crypto. I'm sure we will hear a lot more news in the coming days of what is happening with the platform and with Sam Bankman-Fried, so make sure to check out our Twitter or Instagram to stay up with the latest news. And make sure to subscribe, because we're going to be talking about the cryptocurrency regulation that Sam Bankman-Fried was making with the SEC. He was actually helping create a bill for cryptocurrency regulation. And I'm sure if that regulation was in place, he wouldn't be able to use the funds as he has been. Thanks for watching.